Hi, welcome back. In this session, I'd like to talk about Walmart's recent acquisition of Flipkart and what it tells us about Flipkart and Walmart. Now, putting a few weeks of rumors to rest, on May 9th of 2018, Walmart confirmed that it was paying $16 billion for 77% of Flipkart. That would put the overall value of Flipkart at about $21 billion. Not bad for a company that was founded about 10 years ago. Along the way, though, investors were not that impressed with the Walmart acquisition. Though newspapers announced that Walmart had won the bidding war because the rumored competitor for Flipkart was Amazon India, investors knocked off $8 billion from Walmart's pricing or market cap on the day that they announced the acquisition. So let's take a closer look at the acquisition to see whether the $16 billion was justified and if, in fact, the markets were right in knocking off $8 billion. So let's start with the history of the two companies. Flipkart doesn't have much of a history because it was founded about 11 years ago. Over the 11 years, the company has grown at an astronomical rate, from almost no revenues to more than $3 billion in revenues. That's the good news. The bad news is the company along the way has found ways to lose extraordinary amounts of money. In fact, it's burned through about $7 billion in capital because it's lost so much over the period. In the most recent year, it lost $1 billion. In fact, one of the troubling features of Flipkart is the losses are getting worse, not just in dollar terms, but as a percentage of revenues. Now, if you look at the capital raised, it's not just the equity they've burned through. Flipkart has managed to also borrow money along the way and has interest expenses due, which is making its losses worse. Finally, in its short life, Flipkart has had issues with both transparency and governance, both with its investors and with regulators. So all of that to keep in mind as you think about what Walmart paid for Flipkart. Now take a look at Walmart's history, a much longer and a fairly glorious history. A company that started, that essentially invented the big box, big store concept in Arkansas and expanded it across the country. In fact, to show you how disruption comes and goes, Walmart was the original disruptor of Main Street America, of small stores across the country, and it grew through much of the 80s and 90s at exceptional rates while maintaining significant profit margins. In fact, Walmart was a great growth stock. People tend to forget that now, but it was a great growth company to have. Then you get to the last 15 or 20 years, growth has slowed down, and especially in the last decade, revenue growth is now down to about 2.5%. And along the way, margins have also started to come under pressure. The culprit here is a new disruptor, Amazon, that has changed the retail business and put pressure on Walmart. So clearly, here's where Walmart is right now. Growth has slowed down to a trickle. Margins are getting compressed as competition picks up. And much of the growth that Walmart has had, it's acquired through acquiring Wayfair, Bonobos. Along the way, it's acquired small companies. Its base business, though, remains its big box retail stores across the country, with groceries becoming a bigger and bigger chunk of those revenues. It gets more than 20% of its revenues globally, but its global footprint is not growing. In fact, much of its global revenues come from Mexico and Canada, North America. So it's really not been as successful outside of North America as it has been in North America. So if you think in terms of life cycle, here's where I see Walmart being. It's definitely not a growth company. That's what it was in the 1980s. In fact, I'm not sure it's even a mature company. It might very well be approaching the edges of decline. And that's where we are in the Walmart story. And the question for investors is what happens next. So let's take a look at what might be driving this acquisition. In my view, what's driving this acquisition is a common enemy. Who's the common enemy? Well, it's Amazon again. There's the name again. And it constantly pops up. If you look at Flipkart for the last 5 or 6 years has been under incredible pressure in the Indian online retail market because Amazon India has gone after that market very aggressively. In fact, by 2018, Amazon India had caught up with Flipkart in terms of market share and had pushed Flipkart's losses to larger and larger numbers by underpricing Flipkart. So if you're looking at Flipkart standing alone, you wouldn't be that tempted by the company, right? A money-losing company that manages to lose more and more money. Incidentally, Walmart's pressure from Amazon has come over the last 20 years as it has changed the brick-and-mortar retail business and driven out a lot of the established competition there. Walmart hasn't fallen, but it's seen the effects as well. Now, if you focus in just on Flipkart and you say, well, the company's revenues have grown, but it's losing money. How have investors dealt with it? They've dealt with it by raising the pricing for Flipkart at each capital round. So here you can see how Flipkart's been priced over its lifetime by different investors, and it is some big name investors it's attracted along the way. Barring a short period in 2015 and 2016 when the pricing got knocked down, not in capital rounds, but because existing investors were reappraising the pricing has stepped up each time Flipkart has gone to the market. From 3 billion to 5 billion to 10 billion to 12.5 billion, which was the most recent investment made in 2017 by the Japanese venture capital firm SoftBank. Now, SoftBank invested in Flipkart in August of 2017 at a pricing of 12.5 billion. Of course, Walmart's now stepped in and pushed the pricing up to 21 billion. If you look at motives, one of the motives you might argue is it's a pricing game, because Walmart, by paying 21 billion, has made every existing investor in Flipkart a success, right? For instance, SoftBank has almost doubled its money over an 8-month period. So one explanation for this particular acquisition is maybe Walmart is playing the pricing game and maybe it plans to flip Flipkart over to somebody else. I seriously doubt it, because when you buy 70% of a company, you are not thinking about flipping the company, and when your motives are operational, you want to increase revenues and growth in India, this seems to be a business investment, not a pricing investment. So if the motive was pricing, this wasn't the way to do it. Maybe the argument can be that this is an option. What's the optionality here? The Indian online retail market is a very big one, and maybe Walmart is paying a price to enter the market, in this case a pretty substantial price. Maybe that explains the 16 billion. There is a core of reasoning here, because you could argue that because the Indian online market is large, has tremendous potential growth, and there's a lot of uncertainty, then an option should be worth a lot of money. Well, there's one problem with the rationale. For options to have value, they have to have exclusivity. The only way to enter the Indian online retail market, or the Indian retail market, was through an online retailer. Maybe you can justify a premium being paid for Flipkart, but there are a dozen different ways you could have entered the Indian retail market. This doesn't have to be the way. So if this was the rationale, I think that rationale doesn't make much sense either. The third, of course, is synergy. I mean, you see this word used constantly with big mergers, and maybe the argument here is there's synergy. If the essence of synergy is that two entities coming together are able to do things they could not have done on their own, for this acquisition to have substantial synergy, one or two things has to be true. Either Walmart, by acquiring Flipkart, is going to be able to grow its revenues at its brick and mortar stores in India, or Flipkart, by allowing Walmart to buy it, is able to grow its online retail business much more quickly than it otherwise would have. Neither of those makes sense to me, partly because Walmart's presence in India is relatively small. It did announce it was going to open 50 new stores right after it bought Flipkart, but that's not very much of a presence on the ground. And if you don't have presence on the ground, it's very difficult to see how you can have additional revenues from those stores justify a $16 billion price. And from Flipkart's perspective, I don't see how Walmart allows it to become a stronger competitor to Amazon, other than the fact that it supplies capital to allow Flipkart to survive for a longer period. You think that's a pretty big deal? Well, that means for Walmart, this will mean losses for an extended period as this fight continues. So I don't think synergy also explains it, which leaves me with the fourth and final rationale, and I think this is the one that makes the most sense. Both Flipkart and Walmart are playing defense. Flipkart is playing defense in Indian online retailing against Amazon India. Walmart is playing defense globally against Amazon in the retail business. And when you're playing defense, the argument is you got to keep the other side occupied. Now, Walmart spending $16 billion might be just their attempt to keep Amazon involved, because their fear is that Amazon will take over the Indian online retail market and inexorably march on to global dominance. So maybe this is just Walmart's attempt to throw some money into the battle and extend the battle out. If you're a Walmart shareholder, I'm not sure this is good news, because defensive acquisitions have never been value creating, but maybe they extend the game. What's the bottom line? I think the odds are against Walmart making its money back on this deal, given how much they paid. If the rumors are true that Amazon was the other competitor willing to pay 22 to 23 billion, as a Walmart shareholder, my reaction is maybe you should have let them win. Because if they'd won, they'd have had to deal with the local antitrust people. This would have been viewed as, anti-competitive. They'd have had a fight on their hands. My guess is that Amazon was never interested in buying Flipkart. That's not Amazon's style. When they can crush somebody, why go acquire them? So my guess is that this was just a way in which they got Walmart involved in the process. In many ways, Amazon's won this game by making Walmart pay the price that they did. Looking more generally though, what does it mean for Walmart shareholders? I took a look at Walmart's stock price and whether I thought it was a good value. Taking into account the Flipkart acquisition, I don't think much is going to change as a result of this acquisition. It's not like Walmart is going to rediscover double-digit growth. I think it'll stay a slow growth business with perhaps solid margins. Why perhaps? Because I think the margins are still under pressure. If I value them as a slow growth company with stagnant margins, the value that I get is about $20 lower than the stock price. It looks overvalued to me, and I don't see how this Flipkart acquisition makes it a better investment. In fact, it might make it a worse investment because it might open Walmart up to a period of extended negative cash flows. As for Indian retail in general, I think that this is going to increase competition in the short term in the online retail market. Why? Because Flipkart will now feel emboldened with Walmart's capital backing it up to continue its fight against Amazon India. So you're going to see more price cuts, more intense, better deals for customers, and that's the good news. If you're an Indian customer, these are going to be glory days for you. It's bad for business, but great for customers, and that's what we're going to see play out, I think, in Indian online retail and perhaps by extension in Indian retail. More generally for Indian startups, I'm afraid that this Flipkart acquisition sends all the wrong messages. Wrong messages in what sense? It says, look, if you build a high growth company, even if you lose tons of money and you burn through cash, there will be somebody at the other end who will pay a high price for your company. And I have a feeling that a lot of Indian startups are going to take this to heart and lose even more money for a longer period in return for higher growth. As for investors in India, I think the best thing to do is stay out of this game. It's going to be fun to watch, but you don't want to get caught up unless you are a pricer and you can trade. So it'll be fun. So let's see what the next few years brings. But I think this is the start of perhaps intense competition in Indian retail. Thank you very much for listening.